Hello everyone, welcome to our channel Vales and Tales. In this video, we are going to talk about profit, profit attribution analysis. What is this profit attribution analysis? Why it is even important? This is going to be this part is the most important part of this video. Why it is important to know PAA, and third is let's don't talk about the third. I'm going to talk about what is PAA and why it is important. What are its components also, so we can talk about its components too, and then we will have a more better picture of what this PAA is. First thing first, what is PAA? PAA is a tool, is a process used to understand, used to explain, used to understand, used to explain the changes, used to understand, used to explain the changes in the profit and loss of the trading portfolio. So this is PAA. PAA provide insight into what drives profitability and where the risk lies. So PAA provides insight into what drives the profit, what drives profitability, and where the risk lies. PAA, very powerful, very crucial tool for identifying and managing risk. How? By breaking down, by attributing, by breaking down P&L changes into specific buckets, into specific factors. PAA provides detailed insight into market risk, sensitivity to various conditions. So it provides insight into market risk, sensitivity to various conditions. So mainly provide insights into market risk. It provides insights into impact of new trade and operational cost also, etc. etc. This PAA is granular understanding that allows a trading desk to make informed decision and to adjust their hedging strategies, and more importantly to optimize the portfolio to manage risk effectively. So this is what PAA is. We are going to talk about more in detail about PAA. This was the most important things to keep in mind. What is PAA? PAA provide insights to what drives the profitability and where the risk lies. PAA is a process, is a tool used to explain and decompose the changes in the profit and loss of a trading portfolio. It aims to attribute the daily changes in the profit and loss to various risk factors and the trading activities, and very crucial to understand what drives profitability for ensuring accurate risk management and financial performance. So it is a critical process used by the trading portfolio desk, control team within the financial institutions to understand and explain the change in the profit and loss of a trading portfolio, especially if we're talking about, and in this video we're especially talking about PAA of Delta1 trading desk. We're going to talk about the Delta1 products. What is Delta1 products? We're going to talk about in another video, in next video, or you can, there's another video after this video, Delta1 products. What is Delta1 products? What are Delta1 products? Why there is need of these products? But we won't cover in this video. We are going to cover specifically what is PAA and PAA of what? PAA of a trading portfolio, which in our case is Delta1. So we're going to talk about Delta1. So this is what PAA is. PAA provide insights into what drives profitability and where the risk lies. It gives us the detailed explanation, understanding of the breakdown of the changes in the profit and loss. Now we are going to cover very important, which is why it is even important to know. Why? Two main reasons. First, and then we have other reasons also. They are also important, but there are two main things which piqued my interest is risk management, performance measurement. These are the two interesting topic where I am going to talk more, and then there are two other also, which is transparency and the regulatory compliances. So regulatory compliance ensure that the financial reporting, accurate financial reporting, financial regulations compliance. So we need to maintain accurate financial records. So that's why PA comes in the picture also. And the first one is to have the clear understanding of what drives the profitability of a trading portfolio. So transparency also, so to have the clear understanding of where the profit is going. But this is very important one, which is performance measurement and risk management. PAA helps assist in identifying and managing risk by attributing P&L changes to specific factors, and performance measurement also it assists in evaluating the performance of the traders and the trading strategies. So this we are going to talk in more detail in this video. And if we have time, we will talk about the components also. But by talking about these two important points, we're gonna easily figure out what are the components also of the P and PAA. Well, let's talk about and obviously we are going to talk more about what is Delta1 in next video and why Delta1 products comes in the picture. And then we should also know that why it is in the existence, why it is even important. So we will know that also, but not in this video. But yes, in this video we're talking about PA with respect to Delta1 trading desk. So first, let's talk about the performance measurement. Performance measurement in trading in general is crucial for assessing how traders and their strategies are performing. It helps in identifying strengths, weaknesses, and making informed decisions and ensuring that the trading activities align with the overall goal of the firm. And how we are going to do this performance measurement? By key metrics, which are obviously P&L, return on investment, Sharpe ratio, alpha, and beta. We are going to talk about these key metrics. By understanding these key metrics, we can understand how the performance measurement. We can understand performance measurement of the trading desk. First of all, P&L, total gain or loss made from a trading activity over a specified period of time. If a trader buys stocks for 10,000 and sells them for 12,000, what is the profit and loss? 2,000 profit. Simple. And if a trader buys stock for 10,000, so our initial investment is 10,000. So now I move to ROI. So if trader buys stocks for 10,000 and make profit 2,000, then what will be the ROI? 2,000 divided by 10,000, net profit divided by the initial investment, which is 20%. And now then I'm moving to the Sharpe ratio. Sharpe ratio is again very interesting. What is Sharpe ratio? Sharpe ratio is a measure of risk adjusted return. Simply, we are going to subtract risk from the return, and then we're going to calculate the Sharpe ratio. But the denominator will also change. In this case, the denominator will be the volatility. How much average return is earned in excess of the risk-free rate, but keeping in mind the volatility or the total risk. So if a trader portfolio in our case trader portfolio returns in our case is how much it was 20%, and risk-free rate is 5%, and volatility is 10%, then we can easily calculate this. 20 minus 5 divided by 10%. So what is 15 divided by 10? It is 1.5. Sharpe ratio. Alpha. What are its implications? Obviously, we're going to talk. I'm going to take one example and then we'll cover those implications also. Alpha. What is alpha? Excess return of an investment related to the return of a benchmark index. So if the benchmark index is 5% and our trading desk is earning 15%, then what is alpha? 10% is alpha. If a traded portfolio returns is 15% and the S&P 500 is, let's suppose, 10%, then what is alpha? 5%. Beta. Beta is a measure of volatility. Beta is a measure of systematic risk of a portfolio compared to the market as a whole. So what is beta? A measure of volatility or systematic risk of a portfolio compared to the market as a whole. If a trader portfolio has a beta of 1.2, which it means that the portfolio is expected to be 20% more volatile than the market. So what more than the beta definition? Obviously, definition is also very simple. How portfolio to the compared to the market, how much volatile is our portfolio compared to the market? If beta is 1.2, it means that our portfolio is 20% more volatile than the market. So this is beta, and now we are going to have an example also. So let's talk about example. No. Then we can understand all these key metrics in a more easier way. If initial capital is 1 million and quarter end capital is 1.5 million, and our traders desk has a mainly trades in S&P 500 and ETF. So what is the profit and loss? Very simple, 1.5 minus 1, which is 0.5 million. What is ROI? ROI again very simple, 0.5 divided by 1, which is 50%. Oh my god, it's too much. So let me do 1.15. Now it is good. So it is 0.15, which is 15%, not 50%. It is 15%. Then Sharpe ratio, assuming trader return had a standard deviation or volatility of 5% and the risk-free rate is 1%, then Sharpe ratio is 15%, which in our case is our return on investment, and minus 15% minus 1%. What is 1%? The risk-free rate is 1% and volatility standard deviation is 5%. The Sharpe ratio is 14 divided by 5. It should be, let me use my calculator. 14 divided by 5. It is 2.8. Perfect. Sharpe ratio is 2.8. So what it indicates? Sharpe ratio 2.5 indicates that the high risk adjusted return, meaning the trader achieved substantial return relative to the risk taken. Alpha, assuming S&P 500 return during that quarter is 10% and our rate of return is 15%, so alpha is 5%. What it indicates? It indicates that trader outperformed the market by 5%, showcasing his skills or her skills in generating excess return. Beta, if the portfolio beta is 1.1, it indicates that the portfolio is 10% more volatile than the market. This helps in understanding the risk profile of the trader's strategies, and putting all these together, what we can take, putting all these together is more important. We are not going to analyze in silos. Let's put all them together. High P&L and ROI. So the trader is making a substantial profit and achieving a high ROI, also 15%, indicating his effective trading strategies. Impressive Sharpe ratio. A Sharpe ratio he has in our example 2.8 suggests that the trader generated high returns for the amount of risk taken. Positive alpha, trader outperformed the benchmark by 5%, demonstrating their ability to add value beyond market movements. Beta insight, we also have 1.5, which shows that the portfolio is slightly more volatile than the market, so which is acceptable also given the high return. So if the returns are high, then the volatility can be acceptable 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 given the returns are high, alpha is high, and Sharpe ratio is high. Sharpe ratio, what is Sharpe ratio? Sharpe ratio, again, it means that how much return the trader is achieving relative to the risk taken, related to the volatility. This is what Sharpe ratio calculates also. If it is a measure of risk adjusted return calculated as the average return in excess of the risk free rate divided by the volatility per unit of the volatility of total risk. So per unit of the volatility of the total risk, how much is the excess return over the risk free rate? This is Sharpe ratio. And then we have ROI and P&L also. So these are the key metrics which will help in what it helps in the performance measurement. So performance measurement help in evaluating how well traders and their strategies are performing by using these key metrics. These metrics provide insights into profitability, risk adjusted return, and how the trader performance compared to the market. This evaluation is very crucial for making informed decision and improving strategies and ensuring that the trading activities align with the firm goal. This is important, and this is what we covered here, performance measurement. Another important thing which we should definitely cover is risk management. First of all, there is risk management. There are 4 modules of risk management: asset and liability, credit risk management, and market risk management, and operation risk management. I have those 4 playlists. You can go to playlist and watch those videos in those playlists, and they are going to add a lot of value in if you are interested in risk management, especially from the financial reporting perspective. Risk management, again, very crucial aspect of any trading operation, including our Delta1 in discussion. PAA, it plays a very pivotal role, vital role in this breaking down the changes in the profit and loss into specific components, and this detailed breakdown helps identify the sources of risk and enables more effective risk management. And then we have a components of profit attribution analysis. What are the components of profit attribution analysis? Because by knowing the profit attribution analysis components like market movement, price change, volatility change, interest rate change, position change, new trade, existing position, Greek attribution, delta, gamma, vega, theta, rho. D for delta, delta sensitivity of price changes of the underlying assets. Gamma sensitivity to changes in the delta. So gamma is if delta is a horse, then the gamma is a jockey. Vega, theta, rho, R is rate, interest rate, and vega is V stands for volatility, so sensitivity of volatility, and theta is a time, changes in the time, sensitivity to the changes in the time, passage of time. These are the Greek attributes. Again, PA, one of the components of PA is also funding cost and fees and commissions. So the interest components on the financing, borrowed funds, and the transaction fees and commissions paid for the trades. This also is very important component of PAA. But again, market movement, price change, the impact of changes in the price of the underlying assets, volatility change, effects of changes in the market volatility, interest rate change, the impact of fluctuation in the interest rate. These are the things. And again, Greek attribution, if we're talking about the Delta1 products, so obviously these are very important things, and these are the components. These components are not very important. Important is identifying and managing risk. By attributing P&L to these components, changes to these specific factors, PAA help in identifying and managing risk. First of all, understanding the market risk. What is market risk? We have a full module playlist. We can watch those also. But in a very simple market risk popular definition. What is definition? Potential loss due to the adverse price movement. Suppose the Delta1 trading desk hold a large position in S&P 500 future. If the S&P 500 index drops significantly, the portfolio will incur loss. And if the portfolio will incur loss, then PA will help to quantify how much of the P&L change is due to the price drop. If there is a drop in the S&P 500, then how much is the drop is coming from price drop? How much the P&L change is due to the price drop? This market risk. So we can understand market risk. We can quantify sensitivity to market factors. The Greeks, delta, gamma, vega, theta, rho. Detailed understanding of how the portfolio reacts to various market factors. How much portfolio value changes with the $1 change in the underlying asset price? If the asset price changes by $1, what will be the portfolio value change? If underlying asset price, how much delta will change with the movement in the underlying asset price? Gamma will calculate this. Vega, sensitivity to changes in the volatility. Theta, impacts of time decay. Rho, interest rate sensitivity. If Vega analysis shows high sensitivity to volatility changes, the desk might use less volatile futures, or might go for options to hedge this risk. And the important thing is how to understand this. So we can have an example, like the desk has a position in crude oil futures. So if one day, so desk has a position of crude oil futures, if one day the profit and loss drops by 1 million, PAA will reveal that this 1 million, what are the components of this 1 million P&L change, P&L loss. So maybe 600 million due to the loss in the 600,000 is under the delta bucket, which means that there is a 5% drop in the crude oil prices causing this 600,000. If there is a 1 million overall profit and loss, if there is a drop in our crude oil futures, and if there is on the volatility Vega effect, there is 3 million, then we can clearly understand that 3 million is due to the volatility. So in this way it will help. In this way it will help to understand profit. It will help us to understand. And if we have 1 million loss due to the crude oil future drop, then 100,000, if there is a 100,000 under the trade transaction fees from the recent trades, then we can say 100,000 is under the transaction fees from the recent trades. And then by knowing this information, what will be the impact? What are we going to do with this information? We are not going to sit have a hand by hand. So if it is a PAA will have different buckets. So there is a delta effect, there is a Vega effect, there is a transaction cost effect, there is a new trade impact, etc., etc. There are more buckets also. I'm just giving on a high level these buckets. So in our case, if PAA shows that high delta exposure, the desk might reduce the position size, or use delta neutral strategies, hedging with the option, for example. Volatility management, if Vega risk is high, the desk can hedge using volatility derivatives or reduce the exposure to volatile assets. And then desk PAA will ultimately it will inform strategic decisions by providing insights into what drives the profitability and where the risk lies, as we started our whole discussion. So the desk notice consistent, if the desk notice consistent loss attributed to the interest rate changes rho in our PAA bucket, this insight could lead to the adjusting the portfolio sensitivity to interest rate, perhaps by incorporating interest rate futures. So this profit and attribution analysis is a powerful tool for identifying and managing risk within the trading desk. And by breaking down P&L changes into specific factors, PAA provides detailed insights into market risk, sensitivity to various market conditions, impact of new trade, operational cost, and this understanding allows to make them informed business decisions. For example, in our PAA, there is transaction cost also. So if there is a funding cost and operational risk can significantly impact P&L, high funding cost can erode profits also. So PAA can identify the portion of P&L changes due to the funding cost, prompting the desk to seek more cost-effective financing options, etc., etc. So in this way, risk management, this granular understanding allows trading desk to make informed decisions, adjust their hedging strategies, and optimize their portfolio to manage risk effectively. And this is what we covered here, risk management. So now in this we already know what is PAA and why it is important. So why it is important? Risk management. Why it is important? Financial performance. Why it is important? We know that transparency and to have the clear understanding of where the profit is going, and profit, the changes in the profit, attribution, and then we have regulatory compliance also. So why it is important? We know we have also covered the components of PAA. There are different components: vega, theta, gamma, rho, new trades, and market condition, price changes, etc., etc. Profit and attribution analysis helps in short as to which drives profitability and where the risk lies. So if you like this video, then like this video and I hope this video would have added any value. And thanks for watching. Take care. Bye bye.